All right, everybody, we're going to get started. We're going to just talk a little bit about the loan application process, and then we'll get into some high-level information as far as lines of credit, and then also to finally talk about discussion cash flow analysis, why it's important, and what a bank looks for when we're analyzing a loan. Just a little bit of background for myself. I've been in banking for 14 years. I currently work with Susan in private and professional banking here at Nevada State Bank. So I've worked with a lot of attorneys, dentists. We handle a lot of acquisition loans. We handle working lines of credit for different businesses in your space. I've also worked in special assets, and that's where loans don't go so well. And so we could talk a little bit about just some of the ebbs and flows of what we see on both sides of that, if you have any questions in regards to that also. So we're going to go through the loan application process a little bit. This is especially when you're first coming together, you're meeting with your banker, you're trying to establish a relationship, you're trying to establish some trust. This document that's up there, or that was up there, this is your first opportunity to kind of present what you're looking for and the information about yourself as a bank tries to formulate a decision, whether on creditworthiness, what you're trying to accomplish, what's the purpose for the lending that you want. And this is just a small snapshot. Why is this important? The more information that you can provide to your banker or your banking team up front, the quicker we can get the dialogue rolling and see what's really important to you. Susan talked a little bit about, if we're doing acquisitions, talking about maybe projections like you had talked about in an acquisition. That information, working on your business plan, all that is important. But what you're looking for in terms of money, how much of a loan are you looking for? Is there any type of collateral that you're willing to post, or are you just looking for unsecured lending? All of that hits different buckets, and all of that basically hits a different analysis that a bank will go through to try and come up with a decision. So getting all of this information out there, whether you're looking for SBA, a line of credit, or a term loan, or even a credit card, all important to state what you're looking for, or if there's multiple requests also. The second piece that's very important is just disclosing where you're at personally in terms of your financial life, right? So you're coming out of school, this is your first potential, maybe you're just acquiring a business in the dentistry space, or you're a W-2 employee, how much, maybe you have a contract in place as far as what you're potentially going to make in that position, and then also any debts, liabilities that are related. Just disclosing that, if you've had any hardships in the past that you want to make your banker aware of, all of that eventually comes out in this process. It's a discovery process in the beginning. Just all very important because it helps us identify what your needs are, and it also identifies maybe some potential hurdles or things that we need to discuss a little bit further when it goes to actual credit underwriting. So as we go through that, we have the application taken care of. You're basically just signing to the bank, to the best of my ability, this is the information that I understand, and any supporting documentation that you can provide is also very helpful in the beginning also. Business ownership, business management, if you're 100% owner, I know some of you have a business where maybe you're an LLC, or I heard that there's an S Corp out there. Just disclosing all of that because we're going to do due diligence on all of that information as well. So again, it's kind of your first snapshot on what you're looking for, and this is kind of who I am on paper, at least until we can talk to you in person a little bit further. So after that, we have you sign off. We'll generally get 2 to 3 years tax returns depending on the type of information or the type of loan that you're looking for. Also assign personal financial statement, just stating what your assets and your liabilities are. It'll give us the ability to run your credit. Whether that's something new to you, we'll be able to look at your FICO score, if you've had lending in the past, if you have student loans, just trying to get an idea of just a snapshot in time of what you're bringing from an income and a debt perspective. So from there, we're going to talk a little bit about, does anybody have any general questions as far as a loan application is concerned. It's pretty basic, but it's an important document to just get all of your information out there up front. Yes, sir.
Is this something that is done jointly with your spouse or partner, or is this something that is done singly as the, let's say, the real borrower?
Great question. Certainly, you can definitely, if you're 100% owner of your business, you can fill it out by yourself. If you feel that for the request you would like to bring in additional income sources, say from your spouse or your partner, that is something that can be entertained also, but it's not required. We can look at it by yourself, singly, if you're the owner of the business, or if you're just looking for a personal loan or a business loan by yourself. So it's not required, but some individuals like to go at it as a team. You can bring other streams of income into the analysis, and we can look at it that way also. So we're going to talk a little bit about lines of credit, business lines of credit, and these are different than credit cards. This is a facility that's in place at a bank. It's generally 12 months or less, and this is designed for working capital for your business. You're either going to get this generally from the conventional lending space or the SBA space, okay? The line of credit from a conventional perspective is really for working capital. What is that? You're going to be purchasing supplies. You're going to be potentially needing a small piece of equipment that's vital to keep your operation moving, that you might want to use your line of credit for. Generally, we'll take a look at the types of revenues that you're bringing in or that the practice is bringing in, and trying to assess what would make sense there. Kind of, are you burning cash real quick? Do you have a lot of expenses? Do you have a lot of overhead? Do you have a lot of staff? Do you have multiple locations where you're constantly needing finance? Dr. Weinman talked a little bit about having cash. That's great. You can certainly, as you build up over time, you can utilize that. That's good to see on your balance sheet. But sometimes having a line of credit is also good because, boom, you have a quick expense that came up, and you need to settle it. Also, in regards to receivables, okay? Maybe your payer mix as far as insurance is concerned, maybe there's a delay for whatever reason. There's a delay maybe on the Medicare, Medicaid side. There's a delay with a big insurance company. That can cause a cash crunch, right? That's what your line of credit's there for. Short-term working capital. Yes? In this case, no. So a credit card would be obviously something tangible that you have in your hand that you're going to use really for small expenses. There's also a commercial card, which would be a little bit larger, that we can talk about a little bit as far as buying your supplies. You can get the benefits of a credit card. But a line of credit here, this is generally purposes for handling big expenses that come up in your business. Correct. That is a facility. It's like a big, it's a big line of credit. Yep. Correct. Right. So, and what we're looking for as a bank is, are you able to turn that line of credit? Right. So generally, if let's say you're using it for an insurance receivable, you haven't received it yet, you use your line of credit, you have maybe some payroll to meet, boom, you use the line of credit, that finances it, your receivable comes in 2 weeks later, you pay down the line of credit. So it's kind of a stopgap, if you will, for anything that comes up there. A very useful tool, especially in the beginning of your and just understanding your business cycles, that could come in and out also. Very good also when you're expanding to multiple offices and getting that going. Yes. Yes, it's almost always lower, okay? But it's going to be a larger facility, and there's just terms involved with that. So you have to revolve it and let it rest. Generally, with most banks, it has to sit for 30 days. So basically, it has to sit at zero. Do you have the ability to pay that off, let it rest, let your cash flow pay things off, and then because what happens sometimes is you'll have, we'll see some clients that'll use it for fixed assets because it's a better rate, right? But then the line sits, and we call that it evergreens. It does not revolve. Once that happens, it's going to cause your banker to reach out to you after a certain period of time, and they're going to want to have a discussion with you about why it's not revolving. Because generally, if it's one of two things that it creates. One, the money you're using your cash flow that's coming in to not pay down the line of credit that was used to gap some type of receivables, or you have some type of cash flow crunch going on that we're not seeing maybe in your financial statements. So it's kind of a trigger sometimes as well. And then we just renew that every year. Generally, you'll see, depending on rates, of course, but you'll see your lines of credit be anywhere from 6 to 9%. For those working capital lines of credit, where a credit card you're going to see in 15s, 20%. But this line of credit doesn't give you points, it doesn't give you miles, it doesn't give you anything like that. This is strictly to run your business, really. Okay.
And real quick question, do you all understand what receivables mean? When he's asking, I didn't.
Sure. Okay, so we'll back up there. So your insurance, so if you're taking insurance in your practice, you're going to bill out for that, right? That's going to take generally 30 to 90 days, depending on the different types of insurance products that your clients are offering to you. Okay, so they go in, they give you a copay, perhaps. You get some cash up front, and then the rest is being billed to their insurance. Well, that insurance company is not paying you the next day. That's usually 30, 60 days sometimes, with an average for most bigger carriers, okay? So the line of credit sometimes comes in, you do a lot of work, you have a lot of volume coming in, you're doing the work, but you're not necessarily receiving that cash right up front. Now, over time, you want to be able to have a blend of that, right? You want to have some cash clients, some insurance, but most people are on insurance. I mean, so that's another thing that a bank will look at too, your mix, your payer mix or your insurance mix. Are you concentrated with just one insurer, or are you taking a lot? So it's just in terms of risk, and it's something you want to think about with your business model also, or who you're working for. Are they isolated in just one big insurance carrier? If there's
Like
any type of,
culinary union, maybe.
like the culinary union, for example, it's a great thing. If they go on strike, if they're trying to renegotiate contracts and they stop paying on their insurance just for a period of time, that's affecting your business, that's affecting your pockets. Again, that's where that line of credit might come in. That might be a conversation that, if it's big enough, it's going to get out into the news. You might want to tell your banker about that as well if you're seeing some issues there, just so you can let them know that you're working through that. And then, so it's just emergency. We talked about it resting. We talked about the uses a little bit of the line of credit, and then also with a line of credit, we'll be looking at your tax returns for your business or yourself personally. Generally, you're going to see a working capital line at the business front. So, any questions on lines of credit? Did that make a lot of sense? Did it make sense from the insurance perspective as far as money coming in and out? And then any type of government type of insurance, you'll see that 90. You could see 90 plus days on that, depending on how quickly they're paying and if Congress is approving things and whatnot. So that all affects your business. That's all connected in some way, depending on the types of clients you take in your practice. All right, so we're just going to move, just in the essence of time, we're going to move and discuss the cash flow analysis a little bit. So as you're moving towards graduating, you want to start thinking, do I want to be a W-2 or potentially own my own practice? In the beginning, we're going to look, as a bank, as a financial institution, any financial institution, they're going to look at your business that you're trying to start up or buy into or acquire, and they're going to look at yourself as one and the same. Generally, in the beginning, if you're starting a business up, you're taking salary, you're taking the majority of the profits to basically feed to yourself. So your personal credit history in the beginning, very important. Paying your student loans, if you're going out and getting a house, if you've had issues in the past with short sales, things like that, all of that comes to fruition when you're looking to basically take on a business loan. So it means your personal credit choices really have a big impact on how you're going to start building your business. We talked about the business plan a little bit. This is the secondary nature of that. So you're building your business plan. You have this great idea. You have I'm going to purchase this acquisition. It's a 5-chair location. I believe it's going to create X. Make sure on the personal side that your house is in order when you're coming to the table. It makes things a lot easier. We can have a lot more conversations about that also. So, the bank will look, so we talk a little bit about your business success will be your personal success and vice versa in the beginning. So we talked a little bit about the receivables. Starting your practice in the beginning, we're going to look at your receivable mix in this cash flow analysis. We're going to discount certain carriers depending on our knowledge of the insurance industry, and we're going to look at how long it's taking for you to get paid from some of these insurance companies. So generally from 0 to about 60, give or take, depending on the insurance carrier, 0 to 60 days is the insurance receivables that we're going to count in your cash flow analysis. Anything else we're going to discount, or we're going to have a conversation as far as why is it taking almost 4+ months for you to get paid from any type of carrier. And we're going to discount that. And that comes up with a blended analysis of your receivables and what we may project to believe that your business is going to produce on an annual basis, with other factors in mind also. So really, the longer it takes to collect a payment, the less likely that you're going to receive that payment in full. There could be a collection issue, there could be a negotiation issue with the insurance, or it could just be a client that maybe made a big down payment in cash and said that they were going to pay the rest later, and for some reason that did not happen. Generally, when you do a service, you want to try and get as much up front as possible. But these are all real factors that happen in your types of businesses every day. The other thing that we'll want to talk to you about is how many chairs, locations and chairs. We always like to break down and look at how much revenue per chair is being created from a top-line revenue perspective. So what's your plan to drive patients to those chairs? How many patients are going to pay you up front for your services? And then what's your game plan to collect on the work that you've done?